So I want to talk to you about something that pretty much changed the way that I think about money. It came from a bloke that I was working with years and years ago. He was 53 and like 40 grand a year, nothing special, nothing flashy. But he'd been quietly doing something with his money since his late 20s, well before I met him. And I remember this moment so clearly. He sat across from me, smiled, and just goes, "Josh, I don't really need to work anymore, to be honest, mate. I just quite like doing it." Look, he wasn't rich. He didn't have some windfall or an inheritance. He just had 5 assets doing all of the heavy lifting for him. And that's what I'm going to walk you through today. 5 lazy assets that can genuinely just replace your salary. Not side hustle stuff, okay? Not day trading nonsense. Assets that once you set them up and you build them, basically work for you while you sleep. And no, you do not need to be earning 6 figures for this to work. Some of the people that I've helped build this were on just perfectly normal salaries. But here's the thing that most people get wrong. They think that replacing salaries means earning a fortune, right? It doesn't. It means owning things that pay you without needing your time. The difference between those two ideas, that's the difference between being stuck in a rat race and never getting out of it. So if the goal is owning things that work for you, what is the single most effective one that you can possibly start with? Something that sounds almost too simple to be as powerful as it actually is, which is exactly why most people just overlook it. There was a guy who trained me when I first started doing this. He pulled me aside in like my first year, like back in 2011 or 2010. And he said something that was crazy to me at the time. He said, "Josh, the biggest threat to any investor isn't the market. It's the mirror." And I had no idea what he meant at the time. I was like 21 and I thought investing meant just like picking winners, picking stock market winners. For years, I watched people come into my office convinced that they found the next Apple or Tesla. And about 8 out of 10 of them always ended up losing money compared to doing the most boring thing imaginable. Not because they were stupid, but because they were human. They'd panic when markets would drop, get greedy where things are flying. They'd tinker. And every time they tinkered, they lost. And the data backs all of this up. If you look at any 15-year period, 9 out of 10 professional investment funds run by professional money managers do worse than the market average. Look, if the professionals can't do it, what chance have the rest of us got? So the first lesson here is this. The thing that's going to do the most heavy lifting for replacing your salary, something that you can set up in about 10 minutes on your phone and never gonna think about again. It is a global equity index tracker fund. Instead of finding the needle in a haystack, the next Apple, the next Tesla, you just buy the whole haystack. You just participate in the expansion of global economies. Thousands of the biggest companies in the planet in one purchase. Nothing to tinker with, nothing to panic about. You just set up a direct debit and go to sleep. Now, stay with me on this bit because this is where the number gets a little bit real, okay? Global equity markets have returned roughly 10% per year on average since 1970. Crazy, right? After inflation, that drops to around 7%, but still, that is huge. That is absolutely huge. If you put away £300 a month from age 30, by 60, you're looking at a pot of around £350,000. And if that's sitting inside an ISA, which it should be, the tax man doesn't get to touch it in the slightest. An ISA, again, is just a special type of account that lets you save or invest up to £20,000 per year without paying any tax on any growth or income. Almost every bank, every platform that you know offers it. Just think about that. £300 a month. That is, less than most people's car payment? And to do that, you'd never have to work again. So just think about that. Enough money to get to a point where drawing down 3 or 4% a year, potentially forever, without touching your original money. just from £350 a month. But this is the bit that most people skip. That average, that 10% a year, like I said, almost never happens in any one single given year, right? So it's not like 10%, 10%, 10%, 10%, 10%. Some years you're up 30, some years you're down 20. So what you need to be honest with yourself is, can I watch my money drop by a third and do absolutely nothing? If the answer is no, that's fine. But it kind of changes the plan. I'll come back to that because the answer is actually one of the other assets on this list, okay? So, a global equity tracker grows your money brilliantly. But growth on a screen doesn't always necessarily pay your bills, right? To actually replicate a salary, you need reliable cash hitting your account every single month, even when everything else falls apart. So I genuinely read a stat the other day that kind of stopped me scrolling when I saw it. There are 20 investment trusts, I'll explain what they are in a minute, in the UK that have increased what they pay out every single year over 20 consecutive years. I think it's 58 consecutive years. The top ones, 58 years straight. Through the financial crisis, through COVID, through all of that sort of stuff. Through every recession since the 60s. How is that even possible? Because most investments cannot do that. When the economy tanks, your income usually tanks with it. Well, the answer, and this is the second laziest asset, is UK investment trusts. And what they are is companies whose only job is to invest in other companies and pay you the profits. They've existed since like 1860, I think, investment trusts. But the clever bit is this. They can hold back up to 15% of their income in the good years and stash it in a reserve. It's like a squirrel, right? Like burying its nuts. When the bad year hits, they dip into that reserve to keep paying you out. The industry calls them dividend heroes. So imagine like the economy crashes and your mates are panicking, but you're still getting paid your dividends. That's what these things do. So what this means for you is pretty simple, to be honest with you. You wrap these trusts inside your stocks and shares ISA, and every penny of income is tax-free. If your ISA is earning 5% a year, a full £20,000 pot pays you £1,000 a year, and the tax man never sees a penny. That's your private own growing paycheck. Now, most people, when they hear assets or investing, particularly in this country, in the UK, immediately think property, right? Bricks and mortar. Can't go wrong, right? Well, I worked with this couple a few years back, and actually this is a similar experience to something my parents had as well, who'd bought a rental flat thinking that it would be their pension. I can't tell you how many times I hear that phrase, oh, that is going to be my pension. Within 2 years, despite what I was telling them, they had a tenant who stopped paying them, a £4,000 boiler replacement, new energy efficiency rules, and a tax change that meant that they could barely write off of any of their mortgage costs anymore. It's so unattractive. And I remember I had this meeting with them once, and the wife looks at me and she goes, Josh, this was supposed to be passive income. I've never worked harder in my life. And there you go. It's exactly what I told them. And when you start to look at the numbers, we actually sat down and worked out what it was they were actually getting on their money. She was making about 2% a year. And that is way before you even count the hours that she was putting in to manage the thing. A savings account would have beaten that. All of their money in one property, in one postcode. It's not a lazy asset. It's just a part-time job, right? I'm not a huge fan at all of buy-to-let for these exact reasons. People think it's passive. It isn't. It's the opposite of passive. It drives me crazy when people say, oh, I'm investing in a rental property because it's passive income. It's either completely passive to the point where you outsource all of your management and maintenance to a company, and guess what? You basically end up paying all of your profits to them, or it's active and you've got to take phone calls about a broken shower at 4 a.m. So what's the takeaway from all that? Excuse my rant. you can still get property income. I'm not saying that property is a bad thing, but you don't even need to own a single brick. You have the option to invest in REITs, real estate investment trusts. Now, these are companies that own huge portfolios of property, right? So they're investment companies that buy property. They'll have warehouses, hospitals, student flats, shopping centres, toll roads. Now, by law, they pay out at least 90% of their rental income to shareholders. So you, as the investor in a REIT, collect rent through dividends, essentially. So you never have to unblock a toilet, you never have to chase a tenant or ring a plumber at midnight. Stick it in your ISA and it's tax-free and you don't have to worry about it. Now look, REITs aren't perfect, okay? And again, I'm not a phenomenal fan of REITs. Property values can drop, dividends can be cut, but the average UK REIT was paying around 4-5% last year, and you didn't have to fix a single boiler to get it, right? So if you've ever thought, I'd love rental income, but I just do not want to be a landlord, that is literally what that is. So look, that's 3 of the 5 lazy assets now building towards replacing your salary. But this bit genuinely frustrates me. All of this can fall apart because of one thing that people never think about. Not the investments themselves, the timing. So I was trying to explain this principle to my fiance the other night about market crashes, timing, withdrawal rates, all that sort of stuff. And after about 10 minutes, she turned to me and she basically goes, so basically, shares are an engine, right? It's a car, but you need a seatbelt. And I just sat there and I was like, that was annoyingly a better explanation for anything that I'd come up with in the last 15 years. So basically, here's what she meant. If you're relying on these assets to replace your salary, the worst thing basically that can happen is the market crashing right when you start pulling out your money. Your portfolio drops by 35% in year 1 of your freedom. You're forced to sell at rock bottom prices to pay your bills. That damage basically can almost be impossible to recover from. There's actually a name for this. It's called sequence of returns risk. It's just a fancy way of saying if the crash happens at the wrong time, you're in real trouble. Now, enter bonds, government bonds. Now, I know your eyes are glazing over, but this is the bit that separates people who actually make it to financial freedom and the ones who just get there and blow it all up. The lesson is this. You need bonds. I know people think that you don't, but you do. And remember earlier when I asked you, could you watch your money drop by 1/3? And if you said no, this is your answer. Introduction of a little bit of bonds, UK government bonds. In this case, we're looking at gilts. Now, what they are is loans that you and I make to the UK government to fund its day-to-day activities, essentially. So right now, these are paying like 4.5% right now. Now, that's not going to make you rich, but it's steady and predictable. And here's the key. When stock markets crash, high quality bonds typically hold steady or even go up. That's the whole point. It's what's called negative correlation or low correlation. When one goes up, one goes down. It's like an insurance policy for your money. So instead of panic selling your shares, you live off your bond income while the stock market recovers or your bond part recovers. That patient, that seatbelt is more than ever any clever strategy you will find on the internet. For years, with rates near literally zero, bonds were rubbish, right? All they were was just an insurance policy against stock market crashes. But now they're normalizing at sort of roughly real interest rate returns. They're back in the mix, in my opinion. Right, 4 down. You've got growth, you've got income, you've got property, you've got protection, all ticking over. There's one left, and I promise you, this is the one that people kick themselves most about. It's hiding in plain sight. You're probably already paying into it, and nearly everyone is leaving free money on the table. So after 15 years of doing this job, I've noticed something nearly everyone does wrong. What they'll do is they'll sign up for a job, they get a new job, they're all excited about their new job, and they do all these things that they're supposed to do, like they tick the boxes, they're auto-enrolled into their company pension, that starts kicking in. So that's just when you're basically automatically placed as a member of your workplace pension. They'll contribute the bare minimum and say, yeah, I'm a member of my workplace pension. Brilliant, I'm doing the retirement thing. And then they'll just never look at it again. I was working with a woman last year who was so sharp about every aspect of her money, great with money everywhere else. But when we looked at her workplace pension, she'd be contributing the minimum for years. Now, not necessarily the worst, but what we found out was that she was missing out on employer matching, right? Which is just basically where when you put in, your employer will match your contribution, put in as well, up to a certain level. Tens of thousands of pounds was left just sitting there, unclaimed, gone. Absolutely brutal. Now, here's why that matters, okay? Say you're a basic rate taxpayer and you want to put £100 into your pension. It's only going to cost you £80 out of your pocket because the government adds 20% tax relief, or it's never taken in the first place, essentially. Now, if your employer also matches at this point, they put in another 100 because you've paid in 100. So essentially, if you look through the maths here, you have missed out on £80 today, but you're getting £200 worth of value. That's 150% return. If you are a basic rate, a higher rate taxpayer, so you're paying 40% and above, you get 40% tax relief. Now, read that back. Look, you put in 80, you get 200. Where else does that exist? So what is the takeaway? Find out your employer's maximum contribution matching. Increase your contributions to hit it as a minimum. One form, one conversation with HR. The trade-off is access, of course. You can't touch any pension monies until you're 55, which is soon to be rising until 57 in 2028. I'm so bored of constantly saying that all the time. But honestly, for most people, I genuinely believe that restriction until later in life is a feature, not a bug. It stops you from raiding it when your kitchen needs redoing or when you want to go on holiday. And it forces the money to compound over time. This is your long-term freedom fund. For most working people, for most people in this country, this is the single biggest lever they have to build anything resembling wealth. And do you remember that bloke at the start who was 53, whatever, didn't need to work anymore? He wasn't doing anything exotic. He was doing exactly this, exactly what we just spoke about with these assets. He was phase one. While you're working, maximizing workplace pension contributions to grab every penny for your employer. Whatever's left, funneling into a stocks and shares ISA up to £20,000 a year tax-free. Fill it with global equity trackers. Automate everything. Direct debits. Set and forget. No spreadsheets. No daily checking. No agonizing. You just live your life while all of that builds in the background. Now, if you know someone who needs to hear that, someone who keeps saying they'll sort out their money next year, send them this. They'll thank you. Phase two, as you approach your retirement date, shift some of that growth into income producing assets, dividend investment trust, REITs, bonds. They're converting the engine into cash flow machine. Now, the rough rule of thumb, when your portfolio hits 25 times your desired annual income, your assets have replaced your salary, okay? So that is the key number. That number comes from decades of research. The idea is super simple. Take out 4% a year and your money has historically lasted at least 30 years. Every single time, going all the way back to the 1930s. So if you want £30,000 a year, you need £750,000. Now that sounds enormous, but remember, that bloke on 40 odd grand at the start managed it. Not because he got lucky, because he started doing it early and let the system do its job. But here's the thing, everything that I just walked you through right now, it can completely fall apart because of one factor that I haven't even mentioned yet. And it's not the market, it's not fees, it's not even tax. It's you. It's your habits, it's your mindset, your behavior with money. I have watched brilliant financial plans fall apart because they ignored the person behind the plan, which is why I think you need to watch this video here next, because I'm going to break down exactly what separates people who actually build wealth from people who just talk about it. So click this video right here, because without it, none of what I've just told you is going to work. See you there.